Well, the Petroleum and Natural Gas Regulatory Board has issued notifications on the natural gas pipeline tariff regulations, which became effective on November 18th. To discuss how these would impact the key natural gas players, we're joined by Probal Sen, the energy analyst at ICICI Securities. Probal, thanks a lot for joining in. First, if you can just explain to us, your thoughts on the new pipeline tariff rules, and what could the impact be on this for the industry and for the individual companies?
Well, I think broadly speaking, it is fairly positive if you look at it. The series of moves that have been done. Just to quickly summarize some of the key measures, the ramp up of volumes, which is essentially the nominal volumes that are considered for tariff. That period used to be 5 years. That has been extended to 10 years. And in our country, where where utilization of gas pipelines is anyways running at less than 50%, if you look at it on an aggregate, that is a positive move that allows the companies to sort of spread out the tariff over a longer period, and that is one big move. Secondly, system use charges, some additional costs have been allowed. Thirdly, for capacity expansion for new gas sources, there has been a 5-year holiday that's been given in terms of applicability of tariff. That's very significant, particularly for GSPL, which does have a lot of pipelines that will be connected to some upcoming new LNG terminals, for example. And for them to basically get that leeway while the terminal ramps up, I think that will be a crucial positive. Similarly, there have been other moves in terms of the lower tax rate applicability, which will happen now prospectively from FY24 instead of retrospectively, as was being feared earlier. Broadly speaking, there was an apprehension that tariffs would get severely cut specifically for GSPL to the extent of even 15 to 20%. I think that fear has largely been taken care of. Our rough cut estimates suggest it would probably be less than 10%, if not lower now. And and it also sort of allows the newer pipelines and expansion pipeline to sort of get set up without the fear of being penalized on the tariff front.
Okay.
So it's a fairly aggressive and a fairly reformist measure by the board.
Okay. Hi, Probal. Thanks so much for detailing that to us. There'll be an annual escalation now in tariff on an annual basis. Earlier, I think it was 4-5 years odd. What's the formula they'll adopt, and what are you factoring in?
Well, I think, frankly, we'll have to see the modalities in terms of how that actually plays out of the ground. But on as a principle, having a much more dynamic tariff fixation mechanism is very relevant because of the way that demand and volumes have been very, volatile. If you think about, what has happened, particularly for GAIL, where utilization of their older pipelines is probably still okay for the HVJ and UPL, but on an aggregate basis, their utilization is at 50%. The nominal volumes that were fixed earlier, for example, were at 100% of capacity. And therefore, you can have a 5-year period where you're literally getting underpaid and you're underutilizing, and that shows up in your return ratios. So the fixation on an annualized basis can probably at least correct it to the extent that you can. And I think that's a very, very positive move. Okay. How the methodology would be, I don't think the methodology would change much. It's just going to be on a 1-yearly basis and adjust for, changes in actual volumes and so on and so forth.
But in terms of a timeline, what are you penciling in? When will the next tariff change come in from?
Well, I think the documents and the amendments themselves state that, the applicability will be from the 1st of April, the uniform tariff, and these regulations, the pending tariff order should be in place by the end of this financial year. So even if it happens sometime in FY24, the applicability of these orders and the amendments will be essentially from the beginning of FY24. That's what we understand.
Okay, all right. Probal, do you think that this change will take care of the commoditized segments of GAIL, like marketing, petchem, etc.?
No. I think this is purely a measure for the transmission segment.
Yeah.
And therefore, the impact of earnings, or as and when they get revised, as and when we get the tariff orders, will be more significant for GSPL. Because, they had a lot of more pending issues with respect to expansions and new pipelines. GAIL obviously benefits because, transmission tariffs do get adjusted upwards, hopefully. But the overall impact on the stock should be minimal, is what our sense is right now.
Okay, Probal, since we have you, your thoughts on, good morning, Reliance, how things are set up there? And
I think,
a quick, quick word on upstream, ONGC, etc. as well. Yeah.
Well, we don't, for Reliance, I think very clearly the OTC segment earnings are looking better from a Q3 perspective. I think the margin profile, which, after the weak results of Q2, our sense is that the strong diesel spreads and the strong ATF spreads should actually deliver a, much better OTC segment, result. And therefore, overall EBITDA should actually be up, sharply over the lows that we saw in Q2. So from that perspective, I think, the prospects look better. As always, with Reliance, earnings growth is one part of the story, and the longer term prospects from green energy and the new energy prospects, those remain the key triggers. And as we go along in this year as well as the next, I would say that those will be the crucial monitorables to look at. But from an earnings perspective, I would say Q2 does seem to be a bottoming out quarter, and things should look better from here.
Okay.
For ONGC, I think the people have pointed to the crude softness as a bit of a bearish indicator, but our sense very clearly is, given the adjustments that are being made to the windfall tax, in any case their net realizations are capped at $75, and $75 is still a much stronger number than what they have done if you look at the average over the last decade from an oil realization perspective. And as far as gas pricing is concerned, even if the Kirit Parikh committee, as is expected, declares a slightly softer gas cost environment from the current levels of 8.6, anything over 6.5 is still fairly lucrative, at least for their legacy assets. And for the newer KG Basin asset, they would probably anyways get a premium gas price, which should be closer to a long-term contracted LNG prices, somewhere with some discount here or there. So, from an earnings perspective, I think ONGC does look good. Valuations are extremely attractive at less than 3 times consolidated earnings. So I would be a very, very positive at these levels on the name.
All right, we'll leave it at that. Thanks a lot for joining in, Probal, and have a great day. By the way, the stock of the moment on the downside is Nykaa.